Hello and welcome to today's webinar. Good afternoon. Let me just share my screen in a second. Hopefully everyone can see that. Once again, hello and welcome to this webinar this afternoon. My name is Prashant. I head up the marketing team here at Sharesight, and we are really excited to bring today's webinar in partnership with Betashares on the topic of geared ETF strategies to accelerate long-term wealth creation. And also in terms of what that entails, let me just go to the next slide. We've got some solid pack of content for about 45 minutes. There's Q&A, there's interactive polls all along the way, and we'll take all your questions. So please use the Q&A box to type in your questions, and we'll keep them going. Just a quick housekeeping disclaimer. Sharesight does not have an AFSL, and none of what you're seeing in today's presentation should be taken as advice. Please consult with your financial advisor or accountant before making any investment decisions. And I'm sure Cam has a version of this from the Betashares side as well.
Everyone has a version of one of these, don't they, Prashant?
That's right. The lawyers keep us all on our toes. In terms of introduction, welcome and thank you for educating us today, Cameron. And Cameron is an experienced investment analyst. He's a senior investment strategist at Betashares. He is also, and he looks after all investment strategy, portfolio construction, and product development. He sits on the investment committee at Betashares, and he's a voting member. And in terms of his past experience, he looks a bit young, but he's actually very experienced portfolio manager. He's had a vast amount of experience at Macquarie Asset Management, and prior to that, he was the head of product at Bell Potter and has also worked at JP Morgan. So without much ado, I will hand it off to Cameron.
Thank you, Prashant, for that kind introduction. We've got some great lighting here in our studio, which hides my grey hair, but really great to be with you all here today. As Prashant mentioned, we want to talk a little bit about gearing as an investment strategy broadly, but I'll also talk about the use of geared ETFs and how they can provide a solution in that space. Hopefully you can see the slides shown on screen. There we go. That should be coming up there now. And so where we, obviously here is our disclaimer slide. As you can see, everything is general in nature. And very importantly, we are talking about gearing. Gearing can elevate the level of risk in your investments, and you must be mindful of this. Betashares, just briefly, Betashares is a leading ETF provider in this country. ETFs have really seen strong support across all investor types, from high net wealth, family office institutions, all the way through to down to mum and dad investors. And so we've been very fortunate in terms of the support that we've seen into our funds. There's some stats there on screen. The one I'm most proud of is the fact that there's over 1 million Australians who now invest with Betashares ETFs, and that's certainly pleasing, and it's growing. A bit of an agenda, although I will say, Prashant said, look, if you have questions, type them in. I want to leave as much time as possible for your questions at the end. So, but just to give some structure to today, I want to talk about why you might consider gearing as an investment strategy, and then talk about some specific examples as to, how an investor who faces a particular challenge might look to use gearing to enhance their outcomes or create a certain outcome for their investment portfolio. We should talk about the risks and the challenges. What are the opportunities to use gearing in a portfolio, and what are the sort of barriers to entry, if you like. And then finally, I'll introduce some of Betashares geared ETFs. Before we sort of start on why consider a geared investment approach, I've been working in markets for a long time. My first job in markets was at an investment bank. I worked in what was an area called structured products, which were investment products that use derivatives to provide payoffs. And that was really exciting for me. I love equity derivatives and the complexity of certain payoffs. But what I found is in Australia, structured products before the GFC really were broadly used to provide gearing. And so I should just note there's a poll that's come up. There'll be polls throughout. I'll run through that poll. But I guess what I wanted to impress on you is that I don't want to be tone deaf. We know that in that period prior to the GFC, a lot of investors took high levels of leverage into their investment portfolios and were subsequently burnt by that gearing. And so I want to acknowledge that there are risks in gearing, and that we have seen episodes like that where a large cohort of investors took on a large inappropriate level of gearing and unfortunately suffered pretty substantial losses. When you're using gearing, it's critical that it aligns with your risk tolerance and that the way you use gearing is appropriate for you. So I just wanted to point that out briefly before we started. So there's a poll here on screen, which you should be able to see. Which factor would most influence your decision to invest in a geared ETF? And you may not have a direct answer to that right now. Hopefully you'll have one by the end of today's presentation, but there's a few options for you to select from there. So with that in mind, what are some, really good, strong reasons for using gearing, just generally speaking, within your investment portfolio? And there are a number of, key reasons, but one that I think's, really quite stark is, when we talk about investments, we often talk about the total return of the stock market or even of your own investment portfolio, without really thinking about the implications of inflation and taxes. And inflation and taxes are both, if you like, a headwind to you getting ahead, to you basically creating wealth over time. So inflation reduces the value of your assets in common value. So the amount of, if you like, apples that you can buy tomorrow versus today, inflation erodes that. And we see the taxes obviously are taken out of your returns. So this chart here is sort of quite interesting. It's looking at the level of return you need to generate depending on your tax rate to beat inflation, to ensure that your wealth that you're putting aside is preserved in tomorrow's terms. And what we see here is that you need to, let's just say the current inflation rate, inflation's just come out today in Australia around about 3% headline inflation rate. What this tells you is that in order to stay ahead of inflation, if I'm at a tax rate of say 45%, I need to generate a return in terms of, if you like, the interest I earn on my cash or the income I earn on my investments of just over 5%. Because, the issue that we have is that, inflation can actually help lead to higher rates of interest on our cash accounts. It can mean that, that stocks can grow their earnings over time. And so inflation can be, really good for creating top line growth. But we've also got to consider our outcomes as an investor after tax. And so while we've seen cash rates go up substantially over the last couple of years with higher inflation, we know that for a lot of investors, we lose up to half of that return. So if you've invested in, say, a term deposit or in a cash account with a rate of return of 5%, and you're on a very high marginal tax rate, you're actually going backwards in dollar terms. And this is sort of a critical thing to get your head around. And it points to the fact that if you have a risk tolerance where you don't need to be invested in defensive assets like cash, then perhaps a better way to build your portfolio is to take advantage of what are very high tax rates on interest income. Now, when we earn interest income, we pay tax, but where we pay interest to fund our investment, that becomes a tax deduction. And so by using gearing, we create a potential for a tax deduction, which then can work for us and actually sort of take advantage of, if you like, the tax framework of Australia. So it's really hard to get ahead after inflation and taxes. That means that we've really got to consider carefully whether, defensive assets are right for our portfolio. And in fact, gearing can actually be part of the solution here in terms of getting ahead and building long-term wealth into more tax-efficient assets, like potentially the equity market, where we can benefit from discounted CGT. Now, so we sort of talk a little bit about that conundrum with inflation and tax, but there is this sort of conventional wisdom as to how we should invest. And it's this glide path approach to asset management. You're typically told as a young investor, you should take more risk. So perhaps hold up to 100% of your assets in the equity market, because equities over the long term have a higher expected return. And then as you become, as you age, you, according to common conventional wisdom, you should become more conservative, and therefore you should allocate more assets to things like bonds and things like cash. Now that can work for some people, but it's not necessarily the case that it works for all investors. Think about that young investor. You don't necessarily need to limit your exposure in the equity market to 100%. By using gearing, you can in fact increase your exposure beyond 100%. So in other words, you can put $100 into your portfolio and using gearing get more than 100% exposure. Equally, if we look at someone who's moving towards retirement, now there are investors where it is appropriate to have a large allocation to defensive assets. But if I'm an investor who perhaps has a substantial accumulated savings through their life, which is more than likely to outlive my own life. In other words, I'm easily going to be able to fund my own retirement and I'm likely to pass on assets to my children, then my time horizon for investing has substantially increased. Part of the assets I hold, I'm in fact managing for my children, and I need to think about the risk profile that's more appropriate, in which case gearing can actually make sense. So there are reasons to use gearing at different life stages, and they certainly can add value depending on your circumstances. But before we sort of dive into some of these strategies, because I want to give you some concrete strategies that you can use, it's important to really unpack what gearing is and what it means. And there are various ways that you can have geared exposure to asset classes or to investments. But broadly speaking, gearing is combining your own money together with borrowed funds in order to invest in an asset or into an asset class or an investment. The example shown left on screen here is an investor has $100,000 of their own money and they borrow, in this case, they have $100 of their own money, they borrow $66, and as a result, they invest the total sum into an asset, whether that be the equity market or into housing or whatever that asset might be. And that's described as a loan to value ratio of 40%. That 40% is reflective of the $66 divided by the total invested assets, $166. That's how you calculate your loan to value ratio or your LVR. Now, we know that this provides leverage to both up and down markets. Let's look at scenario one. For the ungeared investor, that's the investor that just puts their $100 into the market. If the market was to go up by 10% on the single day, then as a result, their investment in the market, their capital goes up by 10%. For the geared investor, they've borrowed money. So when the market has gone up by 10%, their gain is in fact 16.7%. So they've got more leverage to that upside. Conversely, on the downside scenario two, when the market falls by 10%, we will see that geared exposure will lose more than the broad market, down 16.7% in this particular example. So that's important to note that exposure and that sort of leverage. There are other factors that will impact your longer term performance, but we'll get into those. But that's essentially a high level view of gearing. That is really the structure that's the mechanics that plays out no matter whether you're using a geared ETF or indeed a margin loan or any other form of gearing. So let's jump into some of these particular strategies. And I really want to give you some actionable ideas here, but I've got 4 strategies that I wanted to take you through as to why you might look to use gearing, in particular gearing into the stock market. But before we do, we've got another poll. What's your primary investment goal? So the options are capital growth, income generation, capital preservation, and speculation. I'll leave you in your own time to respond to that poll. But our first strategy, as I said here, is enhancing after-tax income. Now, in this example, I've got a very simple example based on the current dividend yield of the ASX 200. If I had $100,000 to invest in markets, then if I invested that in the ASX 200 in the broad Australian equity market, I'm likely to generate cash dividends of around about 4,500 plus additional franking credits. Now, if I'm a income-oriented investor and if I value franking credits, then using gearing gives me, a really interesting way to increase that income. So if in this example, I'm able to, by using a loan to value ratio of, in this case, we use 35%, I'm able to increase the allocation to equities and increase the income I can generate. Now, where this gets really interesting is where the yield on the equity market is in fact higher than the rate of interest that I'm paying to fund this gearing. And we certainly see scenarios where you are, if you like, positively geared. In other words, your geared investment can generate more income net of the interest cost than an ungeared investment. And that can be generating extra cash flow out of gearing can be a really, I guess a solid rationale for using gearing. But also we see the uplift in franking credits there. So substantial uplift in franking credits, that overall gross yield around about 9%. So that can be a really strong use case for using gearing. Moving on to the next example, you will have seen that the superannuation concessional contribution caps have been lifted to $30,000 this year, which is good. That means that people can put a little bit more money into super. But we know, and there's been studies done, that estimations as to how much money you need to have in super to retire are only going up. And, this creates a conundrum, frankly, for all investors, but particularly younger investors who don't have a lot of money in super. The compounding power of the market is best taken advantage of by allocating as much capital to the equity market as early on as possible, and then riding out the bumps along the journey. So if you have a positive view on the market longer term, even if you expect some risks of drawdowns in the intermediate period, if you think the market will grow over the very long term, then ideally you want to allocate as much capital as early as possible. And so in a really tax efficient environment like superannuation, you want to allocate money to that environment to grow that nest egg. And by using gearing, you can increase the effectiveness of those contributions. So in this example, I've got a loan to value ratio of 30%, rather than being limited to putting in getting $30,000 of exposure to investments within super. By using gearing, I can increase that to $45,000 of exposure. Now, I sort of call this a boosted dollar cost average approach. The idea is that you contribute the maximum amount you can every year, but you use gearing, and then you're doing that year after year after year. And having those consistent contributions going into super means that where there is a market pullback, the contributions I make subsequent to that pullback will be at a lower level in markets, and that can help me earn out of any dips. And then obviously I get that acceleration of gearing as the markets recover. This next strategy I'm going to talk to here is a little bit more complicated, so bear with me. And it deals with the interaction of the pension system together with your investment and the way that the pension asset test works. So in this particular scenario, we are looking at an example where a particular individual has a portfolio. It's a couple portfolio of around about $850,000. And in this case, we've said their allocation, or their SMSF, if you like, holds $400,000 of value in property, perhaps a one-bedroom apartment, $150,000 in cash, and they have $300,000 allocated to the Australian equity market. And that black part of the pie chart on the left shows that Australian equity allocation. The portfolio is the asset class which they feel best represents their risk profile. So they're quite happy with their asset allocation. But in terms of the way that we manage our assets in retirement, there are opportunities to hold investments and assets which can be really effective in terms of managing overall outcomes, including the pension. And one of those can be lifetime annuities. Lifetime annuities are treated favorably under the pension asset test. So for this particular example, what we said is, rather than holding portfolio A, the investor could elect to allocate to portfolio B. And that lifetime annuity is partially reduced in terms of the assessment of their overall assets, which means they qualify for more pension. So in this case, they've been able to sell down part of their equity holdings to increase that lifetime annuity, so to maximize that effectiveness of the lifetime annuity in reducing your pension asset test, increasing your pension, but replaced that equity exposure with a geared exposure. So with a gearing level of around about 33%, it means that your exposure to the equity market is roughly the same. And on a like-for-like basis, you're basically preserved from an asset allocation or a risk standpoint. The combination of the geared exposure into Australian equities, provided your interest cost is relatively comparable to the yield, plus that lifetime annuity, plus the property, you're sort of preserving the overall risk in a general sense, but you're able to increase those pension payments quite significantly in this case, around about $8,000 a year. So that's sort of quite a simple example of, well, I wouldn't say necessarily simple, but it's an example of using gearing together with the other assets in a portfolio to create, optimal outcomes. And then the final example, and this one's, somewhat straightforward, but, you'd be surprised about, how many people don't necessarily act on this. We talk to lots of investors, across all segments of the market. One is just the consideration as to, where you have debt and whether it's deductible or whether it's not. How efficient are you with your capital? Now, if I am an individual, I own a residence or a house that I live in, but I have a mortgage. More often than not, I still see that individuals that have a house with a mortgage will often still have a share portfolio. And one of the questions that I have is, if you are in that scenario, if you have a share portfolio with no gearing, and if I have a house with a mortgage with non-deductible debt on that, is what is the interest rate that you are paying on your mortgage? Because you can look at that interest rate and look at your marginal tax rate. And often what you will find is the interest rate that you could afford to pay on leverage within your equity portfolio is substantially higher than you might think. And so perhaps I'm better off releasing capital from my equity portfolio, which might be just by selling down equities and just paying down debt, or alternatively, I could use some form of lending in my share portfolio to release capital, release perhaps $100,000 that goes to paying down my mortgage. Now, that question down the bottom, that formula that I've got there is, how much, that looks a little bit complicated, but I'll break it down in simple numbers. If I think about the after-tax cost of interest, if I've got a mortgage which is currently paying an interest rate of 6%, the effective after-tax cost of leverage within my share portfolio means that I can afford to pay an interest rate of around about 10% on that share portfolio and still be slightly better off in terms of the after-tax cost. So it's certainly very valid for a lot of investors to consider whether or not, if I have an outstanding mortgage, I can do more to pay that down. It's non-deductible bad debt, and in fact, just use leverage in an environment like in my investment portfolio, where I'm going to get better tax outcomes. So they're 4 simple scenarios, and I hope that you can see some of the benefits, clear benefits of using gearing. So I guess the question becomes, why don't we see more people use gearing? There are clear benefits. Why aren't we seeing that? And some of these are quite obvious actually. The first is that naturally, as I showed with the that's sort of 2 scenarios early on when I was explaining gearing, naturally gearing increases your volatility. And you need to be comfortable with the level of risk in your portfolio. The real reason for that is that markets don't always, trend in your favor. They don't always go in the direction that you want. And you want to ensure that you're invested over the long run. If your portfolio is too volatile, then there's a higher probability that you might sell out of your equity portfolio and potentially miss a rally and miss that compounding power of the market. So it's important that the level of volatility you take in your portfolio is aligned with your risk tolerance. Gearing does increase that volatility. So you've got to be mindful of that. We also note that gearing does come with a cost, an interest cost. There are potentially other costs there. And so in order for a geared investment exposure to outperform an ungeared investment exposure, you must have a reasonable expectation that the long-term performance will outrun those borrowing costs. And so keeping those borrowing costs, and we'll talk about this, low is absolutely critical to ensuring that you're being very effective in terms of your use of gearing. And the final point is around the risk of margin call and the impact of rebalancing. You know, if I was to use gearing, and let's just say I used a margin loan, I'm sure most people are familiar with margin loans. You might have an initial LVR, but if the stock that I'm holding with a margin loan was to fall, I might be required to stump up more capital or to make a margin call to contribute cash in order to hold on to my shares. But bring that loan to value ratio down, so pay off some of the loan. And if I don't make that margin call, then I risk being sold out of some of those shares. And if the share subsequently rebounds, you can end up with detrimental impacts from this, what we call sort of rebalancing. So there are some risks to consider. But beyond that, just thinking about, you know, the products that have been largely available for a long period of time, you know, margin loans, look, they can be quite expensive. I know the you know, largest margin lenders in Australia, that I looked at their interest rates, they're sitting around about 9%. That's a relatively high bar to beat, 9%. The application process, if you're applying for a loan yourself as an individual, can be time consuming. There's credit checks, there's that risk of margin calls, and more administration comes with managing a margin loan. There are other ways to gear too that don't actually involve a legal loan. There are derivatives, but they often come with a lot of complexity, often extra costs. And also, we often see that derivatives don't necessarily give you good tax outcomes. So not only are they complex, but also on an after-tax basis, they don't necessarily really create great outcomes for investors, Australian investors who pay tax. And then, you know, we see the use of gearing within the superannuation environment, SMSF compliant gearing arrangements. They are necessarily complex to, I guess, engineer their way within the SIS Act. You have limited recourse borrowing arrangements, and that adds a lot of complexity and cost. And we often see higher rates of interest on those style of product because of, you know, that complexity. And then we have another solution in geared ETFs. And I think, you know, what ETFs fundamentally have brought to the Australian investing environment is really, you know, they've dragged down, you know, the cost of investing. And that's really, you know, good for all investors, whether or not that's because people are using ETFs, or in fact, there's, you know, competitive pressure on higher cost unlisted funds. We've tended to see that ETFs have really changed the game in terms of the cost people pay to invest, which is only a good thing because it means that more money ends up in the pockets of the individual investor rather than, if you like, the product provider. Geared ETFs are a really simple solution. They do address a lot of these issues. So I think these are absolutely worthy of consideration. I want to talk to you briefly through some of our geared ETFs, just to give you a flavor as to how geared ETFs can really work for you, and show you some of the choice that's available here. But, you know, in terms of these types of products, like we offer, you know, a range of ETFs with diversified exposure to underlying portfolio. So unlike a margin loan that you might use to buy, for example, CBA or BHP, where you're using a Betashares geared equity ETF, you're getting a very much diversified investment portfolio. And we'll talk about why diversification is even more critical for gearing a bit later on. But because of, you know, the use of, you know, that sort of diversified portfolio, that can be really helpful for addressing risk. These funds are really, you know, quite advantageous in terms of that second benefit listed there, the access to low cost funding. When you're using a margin loan, you as an individual are going to a bank and you're saying, what interest rate can I get from you to borrow to buy shares? With a geared ETF, the fund is what's known as internally geared, or the ETF is internally geared. What that means is it's not you as the individual borrowing money. It's Betashares as the ETF manager arranging a borrowing between the fund and an external bank. So Betashares is an institutional investor and can borrow at institutional interest rates. And the rates of interest that the fund, which in effect the investors in the fund or in the ETF pay, are incredibly low. So more than 300 or 3% lower than those margin lending rates that I mentioned before. So really low rate of interest is really important because, as I said before, the lower the cost of your interest, the lower the hurdle that the asset you're investing in needs to make in order to beat the ungeared exposure. So lowering that interest cost is really a value add, the convenience of not having to go through an application process. And there's also benefits like the ability to get additional franking credits through gearing. I'll talk briefly about our first geared fund, because GEAR and GGUS are familiar to quite a surprisingly large number of Australian investors. These geared funds have been available for over a decade now, and they have been very popular with Australian investors. They were the first geared ETFs launched in Australia. They do provide what I'd describe as a relatively high level of gearing to the underlying asset. So GEAR is diversified exposure to the top 200 shares in Australia. GGUS is exposure to the top 500 shares in the US, the S&P 500. The loan-to-value ratio of these two funds is managed to between 50 and 65%. Now, if I think about that from an exposure basis, what does that mean in terms of the volatility or the movements of my investment in GEAR or GGUS? What that means is on a daily basis, if the underlying market, so in the case of GGUS, if the S&P 500 moves by 10%, or I'll say 1%, then we would expect that GGUS, the value of your investment in GGUS, would move by around about between 2 and 2.8 times that level. So that's to give you sort of an idea as to how much exposure you're getting. So this can be a very effective way to get exposure to these markets. And I show here the long-term performance of these funds. Now, there's a couple of things that are quite apparent by looking at the charts. The chart on the left is the exposure, I should say, of GGUS versus the broad market. This fund has been one of the top 3 performing equity funds available in Australia out of both listed ETFs and out of unlisted funds. Like, there's over 1,000 funds in that peer universe, and GGUS has performed incredibly strongly. I think one of the only other funds that's beaten it has been our NASDAQ 100 ETF, but this fund has done very well over a long period of time. But clearly what you can see from the chart there is it is giving you a higher level of volatility. We can see some of the drawdowns that this fund has had over this time period. With a fund like this, these are very useful tools. They're very effective ways, if you have a view on markets, of taking advantage of that view, of making what can be quite elevated gains. But in my mind, it does require a degree of keeping your hands on the steering wheel and having a view as to when you're going to exit this position due to that volatility. So that's that fund. The fund on the right-hand side shows GEAR. I should note that this does not include franking credits, this performance comparison. So both of these funds over the long term have outperformed. The geared fund, if you also include franking credits, the performance would look quite spectacular, actually. So both funds have done very well. Of course, you can't rely purely on historical performance, but it gives you an idea in a positive market over the long run. Gearing can have a higher degree of volatility. Indeed, these funds have, but you can produce pretty strong outperformance as a result of using gearing. So then I wanted to introduce the 2 new funds that we've brought out in terms of geared ETFs. And I should give credit to the genesis of the idea for what I called our wealth builder funds, or wealth builder ETFs. We had an investor who was using one of our very popular diversified funds, which is called DHHF, which is essentially a diversified exposure to both global and Australian shares. And they wanted to have their DHHF investment as a very long-term buy and hold investment. But what they sort of found was that they thought that if we were able to provide this exposure with a small amount of leverage, that this could be a really effective way of building wealth over the long term. They reached out to us and actually sort of, they basically told us about this sort of idea of theirs. And we spent a lot of time looking at this and looking at the appropriate level of gearing for something which was a lot less high octane, if you like, than GGUS and GEAR. So it was going to have less volatility, but was able to produce what we thought would be very consistent performances or consistent returns over a range of market conditions. And so we launched our Wealth Builder ETFs. The first one of those shown in the middle there is G200. So it's the broad Australian equity, largest 200 stocks on the Australian equity market. The level of gearing is much lower than our previously discussed funds. Between 30 and 40% is the LVR, which means your geared exposure on a daily basis to the underlying market sits around about 1.5 times. So it gives you just a bit more, if you like, juice. The second fund shown there is GHHFs. That's a all-in-one diversified fund to both global and Australian shares, the same level of leverage. So you're getting around about 1.5 times exposure. So we consider these funds more moderately geared. And what I think that means is that investors, can take a more long-term view. They don't necessarily, although it's always important to monitor your investments, don't need to pay as much attention to your investments as gear and GGUS. And I should note, I'm going to show some simulated returns of using gearing for the Australian equity market. There are a number of assumptions that go into these simulations. This is not live performance. It is based on these assumptions, which are shown on screen there, assumptions on cost, assumptions on gearing. But when we looked at the outcomes from using this level of gearing over a period of time, we thought were quite compelling results. The line chart shown there shows the performance of what we describe as a moderately geared portfolio versus the broad market. And I should note again, this does not include franking. So franking is an extra bonus you get on top of this. But what we saw is that the ungeared portfolio generated a return multiplier, or a return of around about 200%. The geared version generated nearly 300% return. So that uplift of around about 1.4 to 1.5, really strong uplift in terms of long-term performance. The other really interesting thing is that because these funds are only more moderately geared, the volatility or the riskiness of these funds is actually, not too bad. We're talking about a diversified exposure. In this table shown here on the right-hand side, you see SMSF top stocks portfolio. So we constructed a portfolio of the 6 most popular stocks held by SMSFs in this country. And we looked at the simulated performance of that basket of stocks, along with the geared and ungeared Australian equity portfolios. And what we found is that using a concentrated basket of stocks led to quite a high level of gearing. Quite a high level of volatility versus the ungeared Australian equity market. And in the middle column, the geared Australian equity exposure actually wasn't much more volatile, but critically the drawdown, if you like. So the max drawdown describes the worst part of performance over a period. And so during COVID, we saw that the geared exposure did draw down by about 50%, which is actually roughly comparable to the ungeared portfolio of popular SMSF stocks. And in fact, that portfolio, that geared portfolio, fully recovered its value, that lost value from COVID, at a period of time which is roughly comparable to the broad market and far sooner than that concentrated stock portfolio. So some of the risk characteristics of using gearing, the risks around drawdowns, the risk around volatility, can be not entirely eliminated, but somewhat offset by ensuring when you're using gearing, you're not just investing in a single stock or say 6 stocks, but you're using a diversified exposure like the broad Australian equity market. And we think that's quite useful in terms of an approach to gearing. So look, I'll invite Prashant back on, but I just, in summary, gearing, it's important that you are comfortable with the risks of gearing, and you must have a view that equity markets will, over the long term, certainly generally appreciate. But you now have a choice of underlying exposures that you can access in a really low cost form in terms of ETFs. As I mentioned, the interest cost within these ETFs is very low. So that's really that's a real benefit of using them. You can choose the level of gearing. You can go for something more highly geared like GGUS or gear, or indeed use the more moderately geared GHHF or indeed G200. So giving you that choice, I think, is really useful. And we think that we're only going to see more of these sort of solutions available for investors, to help them with their own investment journey.
Thanks so much for that, Cameron. I learned so much out of that, both during our practice session as well as now.
Oh, great. I'm glad. Hopefully that was, like, I think there's some of those scenarios can be a little bit complicated. But I think it's sort of worth pointing out those sort of concrete examples of how, an individual with, a particular, set of challenges can actually use gearing to address those challenges.
Yeah, no, and that is really, really insightful. With that, I'll just launch the final poll. While that's going on, there's a bunch of audience questions, and I will read them out. And yeah, we can go through them if that's okay, Cam.
Sure.
Okay, cool. So it says, please could you explain why GGUS is hedged? Is it worth the FX hedging cost? And who decides how much percentage of the fund is hedged, or is it always 100% hedged?
Uh,
Betashares release an unhedged version.
yeah.
So
So that question was about GGUS, was it?
that's right. Yeah.
Yeah. So that's a great question. So for that fund, um, it's going to be, might be a little bit of a technical question, but the most effective way we found to provide that exposure was to ensure that the borrowing was done in US dollars. So in order to fund the gearing, the borrowing is in US dollars. And what that means is that you get a more predictable outcome in terms of the return of GGUS versus the underlying asset being the S&P 500 stocks. If we were to have used Australian dollars an Australian dollar loan to provide gearing to a US dollar asset, you can get some currency mismatches, which create unpredictable outcomes. And so, in our view, for that fund, we needed to use a borrowing arrangement which was in US dollars, and that is in fact what creates that. The currency hedging is the way we use the lending in that particular scenario. So it really was not necessarily driven of a view as to whether or not you are better to be currency hedged or unhedged. It was providing an outcome that people could sort of understand in terms of the ratio of my exposure in the ETF to what the underlying asset was doing. A little bit technical, but I hope that addresses the question.
Yeah, no, that makes a lot of sense. And yeah, just reducing the number of variables there.
Yeah.
Thank you for that. The next question was, how do geared ETFs perform in different market conditions, such as bull markets, bear markets, or periods of high volatility?
Yeah. Great question. So, clearly gearing in a bear market will underperform. You should always expect that. In a strong bull market, generally speaking, if the returns of the markets are higher than your interest cost, gearing will outperform. And like that is what we've seen over long time periods. The threshold really becomes, what is that interest cost? And is the market returning above that? And like some of these ETFs I've mentioned are quite low cost. So that's very advantageous. I think it's also interesting to look at a market where we have volatility or we have a turn, if you like. So that example that I showed on the second last slide that showed a drawdown and then a recovery, that's often a sort of really interesting sort of turning point to use gearing. We'll often, we will see in a down market that, a geared exposure will underperform. The question is, how quickly does it recover? In the case of the moderately geared funds, that historical simulated performance showed that using a moderate level of gearing, we recovered at a time frame which was relatively consistent with a broad market. So I hope that provides some color.
Yeah, that does make sense. Yeah, that's really cool. The next question was on what gearing levels are you using on your ETFs? I think you covered some of that. Do Betashares have similar ETFs like TQQQ, NDX 100 geared 3 times? What is
Uh,
your currency hedging for Australian investors when investing in the US or Euro-based ETFs?
yeah. So we do have some, if you like, geared exposures to currencies rather than equities. So we have, if the question is around currencies, we do have YANK, YANK, which is a geared exposure to the US dollar. We also have AUDS, ORDS, geared exposure to the Australian dollar. I'll treat them as separately. We also have geared exposures in fixed income, but I think it's best to talk about equities because we are talking about, the core asset class used to build wealth. Watch this space in terms of other funds that we might launch in the equity space. I should say that the way that we provide exposure in terms of our geared equity funds, the exposure is always provided by, holding equities, holding equities rather than any sort of futures-based exposure, which, sometimes we've seen in sort of other funds in the US and the like. So really important to ensure that you're holding equities in the portfolio, I think, from a tax standpoint, so that gains can be treated on capital account and the like. But watch this space in terms of other exposures to other equity markets.
Okay. I think you've answered another audience question there, which was, are there more options than the 4 ETFs listed? So
Yeah,
yeah.
so there's other options in currencies, there's other options in fixed income, but watch this space in terms of the availability of other exposures, other investments in the equity space.
Yeah, cool. Here's a really cool question from Nathan. When I get my AMMA to complete my tax return with a geared ETF, does it show the amount of interest paid for the borrowed funds in the fund? And is this the amount that is tax deductible?
That is a great question. So this is one of the, sometimes, it can be a bit of a confusion with a geared fund. If you like the gearing, so if I use a margin loan, I will basically have a tax deduction for the interest. It's the loan that I take out, tax deduction for the interest, and I'll have income from dividends that I received. With a geared fund, the fund is internally geared. So what that means is the fund itself will have that interest cost, and then it will earn dividend income. Now, in the distribution statement, the tax statement that we send to investors in the fund, or I use fund and ETF interchangeably all the time, but in the ETF, those two amounts are offset. That still means that the interest is tax deductible, or is very tax effective to use gearing in the ETF. But you don't necessarily see two separate items when you do your tax return. The two items are netted off. And so as a result, assuming your dividends were more than the interest, you'll see a smaller net dividend income amount, or net income amount, but you don't see a negative amount or a deduction in your tax statement, if that makes any sense.
Got it. Yeah.
It makes it simpler to do your tax return.
That's right. Yeah.
But with the same net outcome.
That makes sense, but great question. Thanks, Nathan. The question from Abhishek, thanks for organizing. Thought to check if there is any ASX portfolio outside of ASX 100.
Yeah, so we don't currently offer Betashares ourselves. We don't currently offer that. There may be, maybe others that do, or there may be unlisted funds, or but our one of our core beliefs is to try and ensure that these geared exposures, or geared fund ETFs, are very much diversified. I talked about how that does somewhat reduce some of the risk around volatility, but we will see how we go from there. We may revisit that in future and offer other exposures. For us, it will be really important, though, that the risk characteristics are right. So we'd need to be very comfortable that the underlying portfolio, if it was another Australian equity portfolio, wasn't too concentrated in individual stocks and wasn't too volatile. So they're the sorts of things we look at when we're looking to provide geared exposure to equities.
Yeah, cool. Thank you. Here's an interesting question from a SMSF trustee. I'm in my 50s now, have a property investment loan, tax deductible, positively geared, and no other loans. Is geared ETF suitable in my SMSF or as a personal investment outside super? I am in the 30% tax bracket. Are geared ETFs suitable for my SMSF based on my age bracket?
Yeah, I guess thanks very much. It's great question, Prashant. That's probably just, I don't want to infringe in terms of being seen to be giving personal advice, because there's quite a lot of information you've given me there. Using gearing may potentially be applicable, but you should probably seek your own personal financial advice, given all those parameters that you've just described there.
Yeah, that's definitely, I was thinking that as I was reading that question. Please seek personal financial advice for that. When you say low interest rate for these funds, how does that interest rate compare to the current home loan rates?
Yes, so the interest rates are, as I mentioned, they're substantially lower than margin lending rates. One of the issues we face is that we are, Betashares acts as an institutional borrower on behalf of these funds. And we've been able to access very competitive interest rates. Unfortunately, one of the things we needed to do was, in order to get such a low rate of interest, is we need to sign a confidentiality agreement with the banks that are offering us these interest rates, because that's obviously something they want to, sort of, I guess, keep under wraps. So I can't actually disclose what the interest rates are, which is somewhat, I'm sure, frustrating for your audience members. But I'll leave it to say that you would find they would be extremely competitive with a interest that you are paying on a mortgage. And I mean, don't forget, this is also tax deductible interest versus a mortgage to buy your own house is not. So there are a number of advantages there.
Yeah. We'll just read out two more questions, and then I think we should get into the final part. Bryce asks, would you consider a moderately geared NDQ or QLTY? And how do you decide the Oz versus international splits for GHHF?
Yeah, so I mean, broadly speaking, GHHF is a relative view via our investment committee as to what's the appropriate mix of Australian and Australian global equities. I don't need to go through all the details there, but it's based on a sort of a risk modeling that we do in terms of the right balance of those asset classes. And in short answer, yes, we would consider those other suggestions, I think, from Ron. So
that's great. Can we get a copy of the slides? Yes, definitely. We'll provide a recording of this webinar, and it will be published on our YouTube channel, and you will get a follow-up email with all the content presented in the webinar. So yeah, I'll take that question. Another question from Abhishek. What are the constituents of GHHF? How much exposure ASX to international? So I think similar question, so we'll consider that answered. How do management fees work with geared funds? I assume it's on the total AUM, so post-gearing, meaning comparing geared to non-geared management fee is a bit tricky.
Yeah, it can be a little bit tricky. The way we describe our management fees is it is a fee on the GAV, or the gross asset value. So if you think about managing the portfolio, you as an investor put in, say, $100. The way the fee is calculated is on, and let's say that the fund, you put in your $100, the fund borrows, say, $40. The fee is calculated based on the $140. So the money that we manage in terms of that equity portfolio. And so you can do a translation from that gross asset value to calculate your fee as a percentage of the dollars you invest, or a fee as a percentage of your net asset value. But broadly speaking, for the moderately geared funds, their fee as a percentage of gross asset value is 0.35%. And depending on what the LVR is, but broadly speaking, you will see that the fee as a percentage of the net asset value of your investment is about 0.5%. Typically, geared funds are going to be slightly higher cost than ungeared funds. That's necessary due to the administration and the requirements to manage the gearing, and frankly, the advantage that we're able to deliver investors by giving them such a low level of cost in terms of the interest burden that they face. So it's really about thinking about the overarching value of what you're getting in that geared ETF, together with the interest cost and that fee, and how that compares to other ways that you might access gearing.
Yeah. Okay. Nice. Yeah. There's a lot of questions.
Yeah,
we'll
great.
just probably one or two more, and then So Gilma asks, is there a minimum amount you can invest with you?
No, so our ETFs are available on the ASX. You can buy them anytime. Typically brokers will not permit you to buy less than $500 on the ASX. That's not our requirement. That's the ASX's requirement, and most brokers enforce that. But no, you can buy from as little as $500. And in fact, we see a lot of people do that. They'll buy $500 every month. And indeed, there are zero cost brokerage platforms, which can be really good. So if you are looking to do that, just a quick plug, Betashares Direct has been launched. It's a great platform. There are zero brokerage costs on buying any ASX listed ETFs, not just Betashares ETFs. So generally speaking, $500 will be the minimum you can invest at any one time.
Yeah. Cool. Thank you. Another question from Paul. Is there any way Betashares can help avoid the loss due to daily rebalancing, volatility decay?
Yeah, this is a bit of a technical question, and it does come up from time to time. So, most US geared ETFs, so ETFs that are available in the US, they will rebalance daily. The reason for that is that it gives you almost, a pure understanding as to what my exposure is going to be relative to the underlying asset by rebalancing daily. So I apologize, we're going to go into the weeds here a bit. And that's because the way that US investors use these funds is they often will day trade them. So they'll hold them for very short time periods. We understand that Australians, aren't necessarily using these funds as daily traded vehicles, and that they perhaps have a longer time frame when they're investing. And so the way that we manage these funds is that we have a range of loan to value ratios that the fund can range within. And if, for example, if the underlying asset continued to fall, the LVR went up, we'd rebalance. And the scenario that, sorry, I can't remember who asked the question, but the name of the questioner, but the scenario that they were asking about was about, can rebalancing impact your portfolio in a detrimental way? So rebalancing can help you if you have a trending market, both up and down, but it can potentially hurt you if you have a market that trends down and then rebounds, and you've rebounded it and you've rebalanced the portfolio slightly in an inappropriate time. What I would say is that GGUS and GEAR do have an element of this because they are quite highly leveraged. And so as a result, you can see more substantial impact from rebalancing. For the moderately geared funds, the level of leverage is quite low. And what that means is that the impact of rebalancing is much lower. And so that was one key characteristic of those wealth builder ETFs in G200 and GHHF that we really wanted to bring to market, was funds that didn't necessarily see as much of an impact from very wild swings in markets. And having that lower level of leverage, I think, really helps in that front. So that's a long answer, but just to summarize, in the US, typically geared funds rebalance daily. This can result in detrimental incomes if you're rebalancing daily. In Australia, for our ETFs, we rebalance less frequently, which helps avoid that. And our moderately geared funds in particular have a much lower level of leverage, so you get much less of that rebalancing effect.
Yeah, cool. Thank you. I think this is we still have a lot of unanswered questions. We'll try to get back to you all as soon as possible with answers to some of those questions. Hopefully, some of them have already been answered through some of the other questions as well as the content. But I do want to take this opportunity to thank our special speaker, Cameron. That was a fantastic webinar. Thank you so much. The content was so good. Like, I learned so much about.
Great. Thanks, Prashant. And thanks also for those questions to the audience. They were, really thoughtful questions, and, good to be able to sort of just, answer them candidly and just engage with the Sharesight audience.
Yeah, no, really appreciate your webinar today, and the content was really fantastic. On behalf of our Sharesight audience, thank you so much, Cameron.
Thank you, Prashant. Thanks all.